Hello everybody, this is AK. I'm back. So for those of you who have been following me for some time, you would know that my largest investment in the local banking sector is in OCBC, right? But my investments in UOB and DBS are quite substantial as well, right? And together, all three banks form almost half of my investment portfolio, and especially with their share prices having risen so much from when I made my purchases, right? So naturally, I would be interested in their results, and I usually would take a look, but I might not make videos or blog about it, right? But this video today is about UOB's first quarter 2025 results. I mean, there has been quite a bit of concern, and I get it in the comments section as well, about how the banks might not do as well because interest rates could see a cut or a couple of cuts towards the end of this year. I mean, the expectations have come down a lot, from 4 or 5 cuts to only 2 cuts this year. And the recent meeting which the US Fed had, the Fed chair, Jerome Powell, said, there's too much uncertainty. They still want more clarity before deciding on interest rates, the path forward, whether they're going to have any cuts and how big those cuts are going to be if they should happen. That's all thanks to Trump's tariffs, which are likely to be inflationary in nature, which means if the Fed wants to control inflation, bring it down, then they shouldn't have any interest rate cuts, which of course is good news for lenders like DBS, OCBC and UOB. They will be able to maintain a net interest income more easily, right? And if we look at net interest income for UOB in first quarter 2025, the net interest income actually increased 2%, and this is on the back of a 6% increase in loans. So there's a loan growth of 6%. More people are taking out loans, and that's something else that we have to consider. Even if interest rates were to reduce and we see net interest margins coming down, we could still see net interest income increasing because we could see loan growth, right? Because low interest rates, cheaper to borrow money, so more people might feel it's a good time to borrow money. But of course, if the Fed decides to lower interest rates towards the end of the year, it might not be due to inflation coming down, which is unlikely, right? Because tariffs are inflationary. Inflation is probably going to stay sticky. So if they reduce interest rates, it's probably going to be because the economy isn't doing very well, right? There could be a recession, and there could be some monetary supply issue, credit issues, that kind of thing, and they might reduce interest rates, right? And if that happens, then of course, in a recessionary environment, the economy is not doing well. Fewer people might take on more loans, right? And that will hit net interest income, right? But for now, there's loan growth, and because there's loan growth, even though net interest margin is not as robust as before, net interest income has gone up. But I've said before, we should be very worried if the banks their only source of income is net interest income. Then we have to be very worried. But UOB has, just like DBS and OCBC, they have fee income, right? Non-interest income. Their fee income increased 20%. 20%. And you're talking about, fees they collect from loans and, from When you get a loan, there are some fees you have to pay. Then wealth management, there are fees that people pay, and then there are credit card fees. Fee income went up 20% to $694 million, right? So that's pretty good, right? That's very good actually. And then of course the next thing I say we have to look at, especially if we are worried about a recession, about how that could impact our investments. Always look at our the company's balance sheet, right? And I keep saying that UOB, DBS, OCBC, they are very well capitalized, a very strong balance sheet. There's nothing to worry about. I don't worry about them going kaput, right? And UOB's CET1 ratio is at 15.5%, very high, right? Very high. That's why they just like DBS and OCBC, they have excess capital they can return to shareholders, which they are doing, right? And they have also been able to reduce costs of doing business. So the cost to income ratio has come down from 45.6% to 42.6%, which is very good, right? So they have been very disciplined when it comes to spending money, and I expect them to be able to improve cost to income ratio, continue to go digital and strengthen that segment, and they should be able to bring costs down even more. So is UOB now still a good investment? Yeah, in my opinion, yes, right? They are trading at like 1.2 times book value, which is not very expensive, to be honest. It's like 10 times or under 10 times PE ratio, maybe 9 point something times PE ratio, which is also rather inexpensive, right? And they're talking about a yield of like 5 point something percent, dividend yield based on a 50% payout ratio, 5 point something percent, which is very good, right? And I don't see any reason why I should sell my investment in UOB right now. And if there should be any big pullback in price, I hope I'm smart enough and I hope I have the money to buy more, right? So let's say if it goes down by 15-20%, in the next bout of market depression, Mr. Market goes into a big depression. If it goes down by 10 or 15%, I will start buying. If it goes down by 20%, I hope I can buy a lot more, right? But of course, being a retiree, I don't have that much income, spare cash. There'll come a time when my war chest gets depleted. So we'll see how things go. But at this point in time, I'm looking at possibly increasing exposure to UOB in the next bout of market depression. So that's all for now. If AK can talk to himself, so can you. Bye-bye.